Hello and very good afternoon to all of you. Welcome to this virtual session on the new economic global order, what it means for Indian businesses. On behalf of ASSOCHAM, this is Avinash Sharma, Director at ASSOCHAM, and we have very eminent experts who will be going to discuss their important views on this important topic. We have with us the Chairman of ASSOCHAM National Council for CFO, Mr. Kailash Vaswani. Uh, we also have Dr. Wasim Hanini, Co-Chairman of National Council for CFOs ASSOCHAM, and very eminent experts from industry, Mr. Ian D'Souza, CFO Bank of Baroda, Mr. Darpan Vashisht, CFO Hero Motors Limited, Mr. K. Arunachalam, Group CFO and Head of Strategy Crompton Grevers Consumer Electrical Limited, who will be joining us very shortly. And to moderate the panel, we have Dr. Suresh Surana, founder RSM India. This program is in we as a knowledge partner. So I would like to request Mr. Kailash Vaswani to deliver the welcome address.
Thank you, Avinash. Good afternoon, everyone. I would like to welcome Dr. Wasim, Co-Chairman for ASSOCHAM, National Council for CFOs, Dr. Suresh Surana, Founder for RSM India, Mr. Ian D'Souza, Mr. Darpan Vashisht, and Mr. Kaleeswaram Arunachalam from various corporates who are the experts who would be helping us today. Basically, the session is very important. It's on the new world economic order, what it means for the Indian businesses, which is being organized under ASSOCHAM, National Council for CFOs. The panel is very strong and they will be sharing the insight on the following topics: the impact of geopolitical developments, rising interest rates and inflation, technology and disruptive businesses, and the tax and regulatory environment, the business perspective. We at ASSOCHAM have always facilitated dialogue between the industry and the government so that the policies and their implementation are in sync with the expectations of the corporate world. We are hopeful to discuss many important things during this discussion and shall be sending suitable recommendations to the government. With that, I pass it back to Avinash to take this forward.
Thank you very much, sir. And now we'll start the panel discussion. And we have, as I already announced, we have Dr. Suresh Surana, founder RSM India, who is going to moderate this session. And I would like to hand over the stage to you, Mr. Surana. Please take it forward.
Avinash, thank you very much. A very good afternoon and very warm welcome to the distinguished panel, to the ASSOCHAM office bearers and committee members, and the members of ASSOCHAM from the trade and industry and friends. As the topic, you would see that the new global economic order, what it means for businesses, is really becoming, in last 1 year, we have seen dramatic turn of events. And there is almost emerging a new world order or a new global economic order. And we are here to discuss what it means for Indian businesses, both in terms of opportunities and challenges. So a quick introduction. I will be acting as a moderator of the session. I am the founder at RSM India, and we are the knowledge partner in this session with ASSOCHAM. If we go to next slide. So the structure of this session is that we have a total of 90 minutes, out of which 75 minutes we would be having discussion. 15 minutes are meant for Q&A. Already we have been introduced to the panel, which is from diverse industry backgrounds. As you will see that we have from the energy sector, from the automotive sector, from oil and gas sector, BFSI sector, and consumer goods sector. So really we can have diverse business perspectives and also insights as to what they are seeing on the ground implications of the changing global economic order. Now, why do I say that there is a new global economic order emerging? So if you see the last 1 year, and we have divided into 4 major, I would say, buckets, the impact of geopolitical developments. So we, after February 2022, we have seen the Russia-Ukraine conflict, and it is not still ending. It is in fact becoming more lethal. We have seen China and US, drifting apart, and the world getting more and more bipolarized. So again, what are the implications for Indian businesses in this scheme of things in the world? That is what we would like to discuss. The second important uh, aspect is in terms of the rising interest rates and inflation. So we have seen inflation really reaching historical peaks. In fact, yesterday you might have seen that US has just announced the in terms of data there is 8.2% inflation, which is the highest in last 40 years. So all over the world, this is not happening in particular pockets, but all over the world we are seeing very high rates of inflation, and we are seeing also rising interest rates. The third major area we are talking about the technological and the disruptive businesses. So again, we are in an era of digital transformation. Last 10 years, we have seen completely new age businesses coming, existing businesses getting transformed, the unicorns and sunicorns coming, virtually by the day. So at the same time, recently we have seen some moderation. So again, we would like to see that what are the implications for Indian businesses, both in terms of opportunities and challenges. And the last bucket is tax and regulatory environments. Again, in that we are seeing number of changes all over the world as well as in India. So what I would be doing is taking each of these topics, and then I would be opening it up for the panel to share their insights, so that all of us can benefit from their wisdom and their experiences. So first important area which we're talking about is the impact of geopolitical developments. So as I mentioned, in the year 2022, we have seen unprecedented geopolitical activities. Like last 30 years, I think ever since 1991, when there was a USSR, restructuring, we have not seen this kind of, geopolitical activity. So we apart from the Russia-Ukraine conflict, we have seen over Taiwan there was a trade-off between US and China, and every day you see statement from both sides. So again, they are drifting more and more apart. The world is getting more and more bipolarized. We just saw recently Saudi changing a little bit of its stance more towards, I would say, China and Russia as compared to a traditional alliance with the US. So India up till now has been adopting a very, I would say, balanced and cautious approach. Also, globally, we are probably going to see, are we going to, and this is a question I would like to pose to the panel, that are we going to see renegotiation of the free trade agreements like what we have NAFTA or ASEAN or, as far as the Eurozone is concerned, and now the free trade agreements following more the political affiliation rather than geographic proximity? Are we going to see, because of the supply chain disruptions and many countries have heavily invested in manufacturing in China, they are going to look at India as the next manufacturing hub to broad base their manufacturing? At the same time, India is also importing a lot of components. So again, whether these geopolitical issues will have any disruption in terms of their own ability to be able to do the manufacturing activities and other activities. Also, we are seeing energy and food security crisis in the world. So again, India, for oil and gas and various other energy requirements, these geopolitical developments can have severe implications. So with this background, if you go to next slide, I would just like to open up for discussion. And let me start with Mr. Vaswani to share your perspective. How do you see these developments for the Indian businesses in terms of both opportunities and challenges?
Sure. Thank you, Mr. Surana. So I would say that the obviously the Russia-Ukraine conflict has been quite an unfortunate event, and the isolation of Russia in the world economic order will have definitely long-term implications on the global economy. We have already seen the impact of war on commodity and energy prices, and the consequential impact that we've seen on inflation, interest rates, and currencies. While the US government, the Fed Reserve is on a mission to curb inflation, in the process, they are literally bankrupting the entire world because of, higher interest costs and currency depreciation, which is following the entire, strengthening of the dollar as it may be. So, the world is effectively bearing the cost of, whatever US government swaps have happened, obviously all the geopolitical events as far as, apart from Russia, Ukraine, in terms of, the Taiwan US or the Saudi affiliation to Russia, it is having massive implications. Uh, Interestingly, India is in a relatively a sweet spot. We definitely had smarter fiscal management through the pandemic, and after that, I think the schemes of the government of Atmanirbhar Bharat are really ensuring that we are very reliant on our own sources for factors of production, be it commodities, energy, or food produce, as it may be. And given the security that we have, we are find ourselves in a relatively sweet spot. And I think yes, there could be a renegotiation of some of these trade agreements, but given the entire rhetoric around some of the large economies, which is either China or Russia in terms of manufacturing base. India is, relatively placed better to grab this opportunity, and it's really up to corporate India, the government of India, to make the best of this opportunity. As I mentioned, some of the schemes of the government, especially around the PLI scheme, the production linked incentive, will go a long way in making sure that Indian manufactured goods are competitive and can sort of compete in the global marketplace. Uh, the government is also sort of providing protection to its own domestic industry, so that whatever reliance we had on imports from China or any other nations, there is incentive to sort of manufacture in India for all of those requirements. So we started off with Make in India back in 2014. We followed up with the Atmanirbhar Bharat scheme, and then the production linked incentive. And we are obviously seeing the fruits of all of these initiatives as we go forward. I would just add, I come from the energy sector. I'm part of Renew Power, which is India's largest renewable energy company. We have seen in our sector again, a lot of the equipment used to come in from China. The government came out with duties and ensured that there is incentive for domestic manufacturing. The PLI scheme was brought in, and there was incentivization to integrate as much backward as we can. So despite having higher energy cost relative to China for manufacturing, with the PLI scheme, we are able to sort of iron out some of those differences as far as polysilicon production and all is concerned. So we are seeing a big opportunity which will play out in that. On the energy front, again, a lot of the new demand for increase in energy requirements is being met from renewable energy sources. And India is the lowest cost producer of renewable energy in the world. And some of those skill sets, we do plan to sort of take to export energy going forward, which will be in the form of green ammonia, where the green hydrogen would be converted into green ammonia and then back in and exported, transported over long distances, and then converted back into green hydrogen. And Europe is realizing that their reliance on Russia resulted in entire impact on their economy, currency, and defense plans to some extent. And instead of that, they just pay a little bit more for their energy requirements, which are more cleaner source based. They do see the benefit of that by not having to rely on say Russia for natural gas or any other requirements. So all that transition is also happening. So I'll stop there. But yeah, there's a big opportunity for India, and it's up to us how we sort of capitalize on the same.
So I think that is very helpful. And so we have Dr. Wasim from the oil and gas sector, Schlumberger, and definitely energy is at the kind of central point of discussion in this geopolitical. Uh, uh, so in that context, I would like to turn to you to have your perspective, Dr. Wasim.
Thank you very much, Dr. Suresh. Thanks a lot, also Kailash, for the great introduction on that. So actually, I'm blessed. First of all, I'm really honored to be here again, and it's coincident to be part of the another seminar is happening right now in the CII also regarding the same topics. So that gives us the how hot is this topics or all these topics. The geopolitical issues that unfortunately the moment most of the globe was out of the COVID situation. Uh, Most of the industries, especially the MNCs, were hoping that the recovery will come soon. Unfortunately, we got the negative impact of the geopolitical development, being Russia-Ukraine issue, the escalation on the China-Taiwan topic, with all the consequences that we have been seeing. I mean, the residual impact of the supply chain disturbance coming from the COVID time, followed by the geopolitical uncertainties. The impact here is, as Kailash mentioned, I mean, the policies that the U.S. federalism implementing, impacting most of the countries, especially the countries where there is a high sensitivity to the foreign exchange. I was with one of the colleagues today, and the negative impact of the geopolitical here on the impacting badly the decision making on the MNCs, where there is a huge conservative approach, if you want, when you will gonna deploy your asset, when you will gonna deploy your investments. I got a question during the current seminar: is what is the long-term outlook? If we look at all these studies, analysis, JP Morgan released a recent update, and they are looking a little bit pessimistic towards the upcoming period. I mean, most of the focus right now is only on 2023. What are the impacts of the current monetary and fiscal policies, the energy changes, the inflation? What is the bad side or negative sides of the unpleasant development in the geopolitical situation? So that creates a lot of pressure on the FDI, if you want. Depends on the industry, depends on the sectors. The good news for India is the huge market. The recovery is very big. Recovery is so fast, if you want. The other part of it, the demand is high. The internal market is very big. The policies that the government is taking, the initiative that the government is taking, as Kailash is mentioning, the BLIA, the Make in India, and the easiness of doing business in India is a very great initiative that is happening. Uh, Unfortunately, this is covered only for the businesses that they don't really need to move huge resources from outside India to India, or they have a less impact on the resource allocation. For certain MNCs where we are seeing limited resources, a little bit reluctant to bring in a huge investment across the globe because of the uncertainties. The allocation of resources will be dependent on the profitability, return on investments, and the buyback period. So in some of the industries, India might not be the best for for the MNCs to invest. In fact, it will be deployed where there is, I mean, I'm talking here mostly about oil and gas, not the renewable energy, but where you have a constraint on the investment, on bringing new investment, actually, or in reality, there is a lot of areas, geographies where the return might be better. For industries where the FMCGs, where we are seeing a huge market here, the investment makes perfect sense for India. We have seen a lot of policies, as mentioned. Some of them are really bringing a lot of financial and economic values. Some of them are, and I'm sure Dr. Suresh will bring that to the upcoming discussions, into how the government is taking certain initiatives on taxes, on GST, on refunds, etc. Some of them are bringing a little bit of negative impact on is the acceleration of it. Right? Unfortunately, I mean, the back to the interest rate impact. I mean, I was in the view, and I had discussed that with a couple of the colleagues in the banking and the investment banking industries. Countries like India and other developing countries will not be able to match the interest rate that the US market are proposing or putting, not because of the rate or percentage itself, because of the risk factors. So I would say that from my personal point of view, that creating more competitive market in terms of the interest rate, where not by increasing it, by bringing better cost of working capital, will encourage the investment and will support the fact that bringing the money to invest in a place where the return on investment is with the associated risk is much higher than the interest rate, that if you invest your money in a zero risk in the US market or other markets. That's what the I would say certain industries, businesses, organizations like ASSOCHAM need to bring to the table, that how we can bring more profitable and sustainable and growing businesses with low cost of capital, that encourage the FDI to come more and more to India.
I think Dr. Wasim, that was very insightful. So what you are saying, cost of capital is going to be one of the key factors, particularly for the developing economies, because in India, we have been having high interest rates in the past, and even now, as compared to the developed countries, we already have high interest rates. And if there is a further top up on that, it will become more and more difficult for businesses to have investment plans and other growth plans.
Absolutely, especially when you are looking at Make in India, supporting the MSMEs, all of them, they need the support when it comes to the fund. You need to bring more support on them by reducing their cost of capital and that way you will get people investing in the Indian market with a high return, rather than sending money outside India into the markets that offering a free risk interest rate.
Sure. So let me now turn to Mr. Darpan Vashisht, who is the CFO of Hero Motors, because again, automotive industry has been impacted by supply chain disruptions. At the same time, I think India is increasingly becoming manufacturing hub for auto components and for the auto sector. So it would be, I mean, we would really appreciate his perspective on this topic of geopolitical developments.
Right. Thanks a lot, Mr. Surana. So first thing is that, I would like to put forth is that even before the current geopolitical, what you can say, disruptions or explosion I think world over the last 3-4 decades had been becoming an interconnected village, right? And that remains true even right now. On the other side, there was a countervailing force that we have seen creep into last decade or so about putting country first, putting the domestic needs first. And that is a theme which you see getting and, coming across in the developed part of the globe as well as in developing countries also. And there are enough and more examples around that. So if anything, I think the latter is going to be accelerated by the current situation. And the first, where we talk about world being an interconnected village, the boundaries are going to be redrawn. And I'll come to that separately. One thing that I would want to say here is that policy and businesses, they go hand in hand. As they say, the fruit does not fall far from the tree. Indian businesses, in terms of their global positioning, posturing, etc., will have to pretty much emulate whatever the Indian government policies have been so far, when it comes to global relationships. The good news is, and as you also pointed out, that India has chosen to play a balanced role. While there are, people on either sides of this, bipolar world can accuse India of leaning onto the other side. But the fact remains that India has so far balanced its image really well. And there are very, very clear economic rationales for that also. The fact is that we are as yet not fully independent in terms of defense sector. If I were to name countries, Russia is a big supplier there. On chemical APIs, there is a heavy dependence on China. Western world remains a very large market for us, both when it comes to software traditionally, and even right now in manufacturing sector, I do see some cutting edge work happening for Western world as a market. Add to that the fact that India, with its large and ever-growing population, remains a lucrative market for all players. So and we have to protect some of these things as we build. So the challenge before India businesses is to transform its supply chain, to transform its capabilities as we navigate these turbulent times very clearly. And within that, we talked about some of the near-term disruptions or issues that we are seeing, namely interest rates going up, by virtue of supply chain lines being redrawn, some bit of inflation coming in, and there will be further more of that as we go ahead. However, there are very, very clear opportunities also. Sitting in automotive sector, I can very clearly say that, we do see a very clear emergence of a China plus one thing, and we are net beneficiaries of that. You see a very palpable move in the Western world to nominate India as one of the manufacturing hubs for that space. And that is an opportunity for other industries also. Another thing, with its large population and by continuing to be a large customer market, consumer market also, this is also an opportunity for us to boost our domestic production, boost our domestic capabilities, production capabilities, and even redraw some of the supply lines over a period of time. So these are very clear opportunities. Some things that we may have so far looked eastward or westward for capabilities, getting them in India will also be an additional business opportunity or employment opportunity or a economic opportunity. So these are two very clear opportunities which I think I can talk about and which we are seeing right now happening within our space.
So I think that is very insightful. We now would move to the next topic, which I think partly you have also discussed during your references, because again these are interlinked. The interest rates and inflation partly are linked to geopolitical, although not entirely. I think partly they are also linked to the COVID-related monetary expansion, what we have seen, and governments went completely, in terms of fiscal discipline, was given a secondary space, and the primary objective was to ensure that we overcome the COVID situation all over the world. So I think inflation probably is I would say, byproduct of at least these two major developments. And also the fact that we have seen very, very low interest rates. I mean, historically, probably the lowest phase for almost 10 years. In some of the advanced countries, the interest rates have been almost like sub-zero. US, Europe, Japan, and even India, we have seen much lower interest rate as compared to what we have been used to earlier. So, but however, in this particular year, we have seen a significant reversal, particularly when you see a 10-year period of fairly low interest rates. So if you see, for example, US has increased interest rate from almost zero to now 3 to 3.25%. The Bank of England has increased interest rate from 0.1% to 2.25% in October 2022. In India also, the RBI repo rate has increased from 4% to now 5.9% in September 2022. If you go to next slide, we will see that, in fact, the situation is much more, I would say, extremely shocking. I think earlier Mr. Darpan used the word explosion. So I think probably, we have seen, for example, some of the countries, Argentina, 75% interest rate, Ukraine 25%, Iran 18%, Pakistan 15%, and Sri Lanka 14.5%. So these are unprecedented. And the indications are that we are as yet not done. I mean, this particular interest rate increase cycle will continue for a foreseeable future, maybe next 1 year, maybe another 100, 200 basis point in the advanced countries, in developing countries, maybe even more. So my question to the panel, or my questions to the panel in this context would be, do they see slowdown in the economic growth across the world, and particularly India? We are more so concerned about India. Already there are indications that from 8.2%, we will be now at 7% or 6.8%. Do they see it further going down? The second question is that in India, the capex cycle has actually been at a relatively lower ebb for last almost 7-8 years, but it was beginning to revive. But with the rising interest rate, do we see that again the companies may rethink about their investment and capex plans? Also, the other question would be that do we see the slowdown in consumer demand because of the lower disposable income, and the impact on the BFSI sector, particularly do they see more corporate defaults and non-performing asset rising once again, and on the real estate sector? So again, you don't have to necessarily answer all the questions. Let me start with Mr. Ian, who is from the BFSI sector. So, and this interest rate and inflation is, definitely much more relevant in the BFSI, and they know the pulse of the entire economy. So, Mr. Ian D'Souza, I hand over to you to share your perspective.
Thank you for that, Suresh. So yes, much has been written in the media in terms of the likely impact of the rising interest rates on the economy. But if you really look back, say over a 10-year period in India, we had a prolonged period pre the COVID and during the COVID period of very low interest rates. So if you see the period prior to that, so if you take, for example, home loans, in about 10 years ago, you were getting home loans at around 10, 25, or if you were able to get it close to 10, you would be a happy person. So today, if you see the home loans have inched up from prime borrowers getting home loans at 7%, it's gone to little north of 8%. So if you see it as a cycle, we are still way below the peak that we saw in our own situation without any triggers or global impact. It's just part of a cycle. So in terms of the cycle, I don't think we are at the peak of the cycle yet. But even if we get there, it will probably not be higher than the peaks we saw in the past. So it's part of the cycle. In terms of the current situation, I think the real challenge is the linkage of India to the global economy, which probably wasn't as strong 10 years ago. So today we are so linked to the global economy. We have billions and billions of dollars of FPI investment coming in, which we require to keep our markets gainfully momentum focused. And that will be determined by the risk-free return that they get in their home markets. So the expectation of return will drive these flows going forward. The second thing which is a concern is the impact of inflation and the way the dollar is strengthening, because obviously that will also impact the returns that they will expect. If they see the currency weakening, then that impacts their returns. So that's one factor that we need to be mindful of. There's not too much that India as a country can do to defend the currency, because the RBI has already spent a good chunk of our foreign reserves to actually defend the currency. It's unlikely they will do so going forward. And so this is a risk. In terms of the positives, not all is lost. And I think the other panelists also mentioned that there are several positives. The positives are in terms of the way the whole situation has played out in China and the continued disruptions that they see. So the story for India is strong. So in terms of exports, we will have exports that are able to harness a better return because of the currency weakening. So I think exports is a very strong sector. Industries within India which are not overly dependent on commodities like which are imported into India, like the oil and natural gas, which they're not too dependent, will be able to survive and do well. So one area which remains a concern for me and for the others in the BFI sector is the SME sector. So they've just about come out of a very trying and difficult time due to the pandemic, the lockdowns, and even pre-pandemic, there was a little sluggishness in the economy, which followed demonetization and introduction of GST. This impacted SMEs the most. So for the SME sector, we will have to figure out a whole plethora of initiatives to help them grow. Perhaps the SMEs need to shift their focus away from the traditional areas into more value addition and use of technology. I think that will help them cope with the difficult times that we have ahead. If they and we will have to help them as a Chamber of Commerce, as the Government of India, and as the entire banking community. We will have to have knowledge sharing and initiatives. So while the Government of India through the pandemic took a number of initiatives in terms of liberalized credit and moratoriums towards repayment, I think that is something we will continue to see. But a focus shift will probably be required. One other aspect which I'd like to highlight and which is unique to India is the kind of digitization which we've seen in the last 6-7 years. And even the World Bank and the IMF have talked about how the last mile in terms of bridging the gap for the underprivileged and getting directed benefits into the last man's pocket is a huge win and phenomenal. It's never been seen elsewhere. So there are a lot of positives, but yes, difficult times ahead, especially since India will have to maintain the interest rate differential between our market and the developed market. So it's really outside our control as to how we see interest rates move from here on forward. It's not only about local domestic inflation, it's how other foreign banks, central banks deal with inflation in their countries that will also impact us. So this is something which is outside our control entirely.
I think that is very helpful. I'll now turn to Mr. Arunachalam, who is the Group CFO and Head of Strategy at Crompton Greaves Consumer Electricals, to share his perspective on the rising interest rates and the high inflation and exchange rates fluctuation.
Sir, he has not joined, so you can ask this question from another panelist.
Okay, sure. So I'll come to Mr. Vaswani because he's I think probably having connect with several industries. So how does he see implications of these rising interest rates and inflation and the exchange rate as we talked about just now?
Yeah, sure. So, I think starting with the energy sector from where I belong, interest rates has a direct impact because, for us, capital is a key raw material. And we have to borrow large amounts of debt to finance some of these projects. So interest cost eats up a lot of the EBITDA. Now, a lot of companies, rely on debt to meet this requirement, and because of that, the exposure is there, in the energy sector to a large extent. In our case, because we in a way, uh, you know, saw that the interest rates are very low at some point. Obviously, the cycle had to turn, so we did a lot of fixing of interest rate. So that has helped to some extent. But another thing which is important to appreciate is that while interest rates have gone haywire in the US and in other developed economies, in India the interest rates have moved in a very gradual manner. The inflation is very well reined in, I would say. It is high, of course. It's higher than where the RBI would like it to be, but it's not gone out of control. And I guess some of the initiatives of the country in the past few years have enabled us to sort of keep that very well controlled. The impact of that we're also seeing in the domestic market. Well, literally till couple of months back, the liquidity is still very robust, and borrowing costs were still relatively low. It's just literally in September, during the advanced time period, we have seen liquidity becoming tighter, and then the short-term rates sort of spiking in the middle. But I would say that still the government securities, the GSEC rates have moved from 6.3, 6.5 to around 7.5%. So 100 basis point expansion that we have seen. I agree with the panelists that the Indian rates we've seen much higher than where we are currently. So I don't think we may end up all the way till that point. We may end up somewhere before that. It's important for businesses to plan their capital expansion projects, keeping in mind some of these interest rates remaining high in the short term and then perhaps softening over a longer period of time. and accordingly, the cost has to be baked into any expansion that is done, and I think that is what will help us. Um, the other thing which I would like to add is that the Indian interest rates are increasing more so to keep in track with the global interest rate increases. As I said earlier, the inflation is not very much out of control. It's more the currency that the country would like to sort of defend. And if there's a big differential, then that is something again which may not happen. That's why the interest rates definitely need to be higher. I think the impact as far as the retail side is concerned would be seen maybe a year later when we see the impact of recession across the world impacting jobs, etc. In that case, there would be some sort of impact as far as consumption is concerned. But again, in consumption, we have seen a very big boom and a cycle which is still continuing despite all the headwinds in the world. I think Indians continue to consume as much and more as they can because the disposable income still remains very high. In case there is companies which have a lot of global reliance, I guess as far as either the software side is concerned or the BFSI, or some of the startups where we've started seeing some sort of layoffs, job cuts, then that can have some minor impact as far as consumption is concerned.
Yeah. So let me turn to Dr. Wasim because he has really a lot of global experience. He's worked in different parts of the world and is right now probably witnessing also as in view of his responsibility in the Asia Pacific region, different kind of interest rates, different kind of inflation rate across geographies. How you think a CFO should be right now dealing with this kind of extreme variations?
Okay, so thank you again. In fact, as I mentioned earlier, I mean, this situation bring the all the management, I mean, finance and the management to take um, different views and more conservative views. Number one. Number two is looking for a very quick return and very high return to monetize or to de-risk the current situations, right? Now, as I mentioned, I think the risk of the high interest rate on the market, I mean, when you are doing a lot of internal businesses and supporting the Make in India, supporting the MSME is very high. All this, as I mentioned in the previous discussion, that all this type of enterprises require the high fund, and the high fund will gonna come from loans, from capital, from venture capitals, where you cannot increase the cost of capital for them. On the other side here, uh, the situation where adding this will gonna increase the cost for the. I mean, if they end up getting that at the high rate, they will increase the cost. They will on the ultimate consumers, and eventually this will increase the inflation. We are just supporting, and in fact, we are not fighting against the inflation in this type of environment. We are increasing the inflation by increasing prices rather than in an economy like India, very big economy. We have to support the growth rather than supporting the inflation or controlling the fund flow. And India is well known, I mean, historically for a lower cost and higher value or higher volume, if you want. So, as I mentioned, the most of the CFOs right now are taking more conservative approach and sometimes aggressive in a sense that on the return that they are looking at it and in the developing countries. Um, if in my position, I would say we need to work as in Indian economy to get a leverage on the lower INR right now. I mean, so we have seen many countries. Some of them they were kind of a good examples. Other of them are not really the perfect example. I mean, I will look at it maybe in a country like Malaysia, where they use the low Malaysian ringgit to support their tourism. Turkey was not really successful, despite that. I mean, mostly because of the very aggressive approach, but also that they got a lot of benefit when it comes to the tourism in the last 12 months because of the currency. Maybe they were negatively impacted by the geopolitical, but if I go back to Asia Pacific, I would say focus more on the tourism. In India specifically, I think the one of the key elements, we are keep blaming the high energy bill for the foreign exchange. I would say it is more towards, it's not about the energy, it is more about the growth driven demand on the input that's coming from other countries. Many of them are coming from land border sharing countries, right? Now, I think the equation, the balance, or I mean, the current imbalance on the in the balance of payment should be in the other way around. We need to support the small or the local companies by dropping their cost of capital to support them, and in fact support the importation using that low INR now to go beyond the in the different markets. There are a lot of initiatives that is happening right now. I mean, a lot of agreement, as you correctly said. There is a new restructuring, if you want. Not really deglobalization, but it is really understanding the different alignment or allies, if you want, on the global economy, from previous Asian or NAFTA, etc., to more kind of a mutual or kind of dual party or tri-party agreements we have seen between India and UAE. This is the best example that can work. I mean, for India, between turning the balance into in the favor of India towards of the most of them. I'm originally coming from Middle East. I would say most of the countries in Middle East, the country is big to the US dollar. We can benefit from that foreign exchange towards India. The agreement between India and European Union, the agreement between India and Australia, and other countries. I think now with the focus more into more supporting the Make in India, more supporting the MSMEs, and go from local to global. I mean, support the local businesses to be more global, where you get the benefit of cheaper input. I mean, not only not. I mean, India being a hub, not only now where I know you were gonna touch base on what we have seen, the COVID, where a lot of companies who are doing services, we need to consider this part of the economy as well, the ITS element, right, where we are seeing more than 4 to 5 million employees are doing that and going really global. We need to support this, get the benefit out of it, and we support more smaller industries and manufacturing to go more global.
Yeah. So I think just
not
important point, Dr.
focusing.
Wasim, just important point I don't want to miss, and maybe just ask Mr. Vaswani about that, because you mentioned about the free trade agreements, and while India signed with UAE, there has been a lot of discussion around possible agreements with UK, US, Australia. Are you seeing anything coming soon, Mr. Vaswani? Because you are...
No, I'm not fully equipped to answer that. No,
Okay, sure.
I wouldn't
So
know.
I'll move to now my next question, or the kind of next bucket. So which is in terms of the technological, in terms of technology and disruptive businesses. So last probably we are in the era of digital revolution. Last 10 years we have seen e-commerce players, we have seen aggregators, edutech companies, and also electric mobility, and a number of new age businesses coming up. And in fact, that is what has been also driving a lot of growth in the last at least 2 or 3 years in India. In terms of, so the existing companies are redefining the way they are doing business by using technology, by in terms of online selling, by using digital channels. There are completely disruptive business models which we have seen, and emergence of new business model like Uber, Paytm, you have Zomato. Even in educational field, we have seen, Byju's, we have seen Big Basket, Zepto. So again, last, I would say 2-3 years, we have seen massive activity in terms of the startups and even the businesses getting redefined. And because of the COVID, the digital adoption across the system accelerated. And also the cost of assessing technology also has gone down significantly. Earlier we wanted to do a meeting like this, it would cost a huge fortune, but today we are able to do at the fraction of the cost with the telecom now 5G coming in. So I think digital acceleration has been an adoption across the board, including governments and the private sector and other stakeholders has been very quick. Having said that, in the last 12 months, we have seen some major developments. So if you go to next slide, for India, pretty much, information technology and back office, India is known as the IT and back office of the world. 55% of global offshoring happens in India. And our this year exports are expected to be $227 billion and high employment generation because this is not having raw material content. But we are now with this economic slowdown globally and also this phenomenal valuation of tech companies crashing. I mean, NASDAQ has come down almost by 1/3. Although yesterday, it went down 4%, came up again almost 6% back. And but the point is, we are really seeing a huge correction in the valuation of technology companies. The funding for the startups is beginning to be under stress and drying up. For the first time, probably now, last few days, we are seeing news items of startups laying off people, which we never heard. They were just hiring. So also in the automotive sector, for example, we have seen electric mobility. So let me turn to Mr. Darpan because of Hero Motors, how he sees this whole technology and disruptive businesses for India.
Right. So I think I'll break down this particular question into 2 or 3 different layers. The first is that as far as modern economic history goes, economies go through an industrial cycle. Industries go through a life cycle. Right from railroads in US, which were in early part of 1900s, to .com at the turn of century, to e-commerce before that, modern trade, etc. A new business model is found to be promising. People rush to that. A lot of people rush to that. Regulators try and come around the new reality, try and move in, formulate regulations. There is a lot of weaning out of weaker players. There is a lot of consolidation which happens, and over a period of time, you see some sanity prevailing because finally it's the for any business to be sustainable, it's not about a 2-3 years game. If you want to give a business or an industry legs, it has to be a longer haul. And somehow, whether it is because of human desire for making quick cash, whether it is because of whatever reasons, but this cycle seems to repeat. And possibly that's what we are seeing some bit into our tech-enabled space also. There are very valid and palpable wins for tech businesses or for areas where technology has touched our lives. So whether it is transport aggregators, whether it is food services aggregators, whether it is e-commerce overall, there has been a very, very palpable, very, very real habit change. And people are far more comfortable doing those things. Maybe 10 years back, people would have balked at the idea of ordering a trouser or a shoe, which is over a computer. But today these are realities, right? So in certain areas, while the habit formation has happened, I think the real clear winners within these spaces will be companies or players who are able to establish a long-term business case or a sustainable cash model, right? And that's what we are seeing. I would not be so much impressed by near-term valuations on unicorns, etc., right? And that's what we are seeing all around us. I mean, there might be overheating of a certain company's stocks or overheating of a sector, but over a period of time, the reality kicks in and there is some bit of value erosion. which may not be equal to the earlier value explosion or increase which might have happened. So very clearly, some things are here to stay. Whether the same players will be there tomorrow or not, that's the moot point. Is it an opportunity? Definitely an opportunity for all businesses. Very clearly, if we look at when we talk about e-commerce, we like to talk about Amazon, we like to talk about other players. But if you look at players like Walmart in US and outside of US also, they have been able to adapt technology very rightly, and they have been able to make a successful play out of that. There is today a sizable revenue of Walmart globally comes from e-commerce. They have been able to do that well. Other companies, Nike, and there are many more examples where traditional companies have been able to secure wins. Uh, what they tried to do was not something outlandish. They saw an emerging trend through their resources behind that, and have been silently and methodically building capabilities around that. So there are those examples. Closer home, I would say that in Reliance we do see a player who is comfortable both with offline as well as online digital presence also, and hopefully and the way they are consolidating it looks like that they might be a version similar to Walmart of US, right? So there are very clear opportunities for businesses to adopt new technologies or new tech spaces and grow their business. If I were to talk about e-mobility, again, the same thing applies. Right now, there is a global push, there is a global demand. Regulators are soon, are very clearly waking up to this idea. And I would argue that right now, while the growth opportunity is immense because of the low size of e-mobility market, but a lot of conversion, especially in countries like ours, will happen because of government interventions. Compared to, let's say, traditional ICE, internal combustion engines, what e-mobility does not have today is advantage of scale. That's where things like PLI help. That's where impetus from government helps. That's where directives from government and regulators help, right, in terms of growing the industry. Additionally, I think enablers like infrastructure, etc., need to come into place for e-mobility and such new technologies to find their true place in the sun. In fact, one interesting thing, I would just want to draw a parable on the e-commerce success. Aside of technology, one big enabler for commerce success has been the last mile logistics. And today we have pure play last mile logistics companies as a result. So because that was a key enabler to success of e-commerce, the same way infrastructure is going to be a key enabler for e-mobility, and I think we will see players opportunities around that. Again, just like any other sector, this is not a technically a black swan where people didn't see it coming, but the fact is that you see a lot of non-traditional auto players also into this segment. The learning out here is that they reset the ground zero. The race starts from here and now. So the older players have to be far more agile. The newer players have to scale up faster. I think those are learnings out there. Coming to use of technology for operations, one thing which I do see is that there are two ways in you can adopt technology. One is technology for the sake of technology, whether as a business model or as a use case, or you can actually build a business case around that and integrate it into your. So when there is a real, tangible, palpable need and there is an economic rationale of that, that's when technology adoption is what I would recommend. Otherwise, it's just a whether as a separate branching out of business or as a process enablers, it just is a cost center in that sense.
I think that is very well said, because are you really believing in technology and making it as a culture and DNA, and or rather just being in the, because that is the buzzword and that's what you really need to be seen to be doing.
Right.
Let me just ask Mr. Ian very quickly, in the interest of time. Does he see in terms of this tech companies valuation, and particularly in terms of the traditional IT companies which have been really driving the Indian economy? If you really look at the companies like TCS, Wipro and Infosys, they've been really employing large number of people with fairly good income levels, which has been the growth engine for India for last 20 years. Do they see that there is a probably slowdown on that side, as well as this startup, both Because as a banker, you would have the pulse of what is happening in the economy.
It's a very relevant question because these are two very different segments. The TCS and the Infosys have taken almost 3 decades to build up, and it's clearly based on both cutting edge technology as well as brick and mortar. They have development centers. Whereas if you look at the new age fintech, they have a very light footprint. So in terms of valuations of the fintechs, it is actually for a professional like me, it is unimaginable because it does not have the EBITDA of a TCS or an Infosys. It does not have strong dollar inflows. It does not have a clear top line. So you had think concepts like GMV, which drive a fintech valuation. So I'd like to sidestep the question of fintech valuation for a bit because I think it'll require far wiser set of minds than me to comment on that. But to talk about the value that fintechs add, in terms of, I think it is the incubation hub because while you have the larger IT companies also innovating, I think fintechs are the cutting edge of innovation. And it is these entities which will help develop India in terms of what's new, what's not been thought of, and new ways of doing things. I think that's where these thousands and thousands of fintechs will help drive innovation in India. And there should be a mentorship program to guide them and to ensure adequate funding for them and so that we remain at the cutting edge. That's where the innovation will come and will help India be at the cutting edge of technology. In terms of the established players, I think what could be a pitfall for them and which is not in their control is if a recession helps sets in the developed markets. For example, in response to the commodity crisis that's being faced because of the Ukraine-Russia war, there could be a curtailment in energy imports into Europe. And if Europe slows down or the inflation in the US economy continues to rear its head and there is a bit of a dip and recession, there could be a reduced order flow for these large established companies. So I think that could be the worry and fear for the future. But as of now, as these companies are declaring their Q2 results, that doesn't seem to have happened yet. The order book remains strong and it looks like things are all right for now. But as I said, if the situation continues to unwind, they could be impacted.
Yeah, I think that is very helpful. So let me move to the last part of this discussion, which is in terms of the if we look at the tax and the regulatory environment. Again, a lot of changes have happened. For example, OECD has come up with a global minimum tax of 15%. There's a lot of cross-border information exchange. We are also seeing the taxation of the digital businesses, particularly because earlier our traditional taxation was based on in terms of physical presence or permanent establishment. Now with the digital presence also getting into the tax net, heightened governance requirements everywhere. The CFOs, CEOs, audit committees, compliance officers, more and more, I would say there are in terms of governance and regulatory requirement, and expectations are also becoming higher and higher of all the stakeholders. Finally, the digitization of tax laws, because India has done rapid digitization. We have seen GST completely being digital, and also it is uniform indirect tax regime in India now, which was one of the earlier stumbling block for manufacturing activities. Faceless assessment for direct taxes. I think other day we were doing a webinar with the CBDT members who are in charge of this. India is the first country in the world to introduce faceless assessment, and it was really remarkable. And the lower corporate tax rate for manufacturing companies. So again, there have been but some people have been complaining that there is probably too much of compliance or regulations, and the ease of doing business is not as great as it looks. So again, on the ground, and this is one of the core areas for the CFOs in terms of their responsibilities, how they see all these developments. Has the situation really improved, become easier, and also what are the major positives from the tax and regulatory and front, and what are the challenges? So let me pose the question to just let me just. So let me start with Mr. Darpan.
Thanks, Mr. Surana. I think I'll keep this short. I think that it's a mixed bag so far as corporates or individual business leaders are concerned. On certain sides, there are very clear wins. When we look at direct taxes, the whole faceless assessment, rapid e-filing, etc. These are things that have happened very well. The lag time of getting a return done, the lead time of getting an assessment closed, etc. That has phenomenally been cut down. I am yet to see the official numbers, but you talk anecdotally to people, both at a personal tax level as well as corporate tax level, massive improvement in the speeds. And even in case of discontent, etc., at certain places on assessments, there are the channels that were open for appeals and arbitration. They are still available, right? So on the direct exercise, one sees a very clear win. If I were to look at GST effort, and I happen to have changed a couple of employers during this period, the whole effort has been overall the cost of compliance. I mean, if I were to look at corporate taxes plus GST, etc., the cost of or overall regulatory structure, I think the cost of compliance and the effort of compliance, that has certainly gone up for at least the companies or the people that I've talked to. What are the palpable benefits of that? Obviously, you get records at one place. Some reconciliation might be easier, but again, those fruits are yet to come through. In certain cases where the rapid deployment of large-scale initiatives like GST has happened, it has been a learning curve both for regulators as well as for companies. And so that's the India context. Mixed bag, I would say. In certain, but having said that, I would want to say that the cost of compliance certainly has gone up, and some clear wins out there.
Yeah. Let me go to Dr. Wasim. How you see the tax and regulatory environment in India as well as in the Asia Pacific or the global,
No, thank you very much. Actually, I'm just turning 3 years being in India. Yesterday, I turned that, and actually, as I mentioned, I'm in CII meeting where the secretary of DBIIT is here. I think the change that I personally faced very positive in terms of the digitalization of the process, the compliances requirement, as you mentioned, the faceless audits. In fact, the timing of the refund of the indirect taxes, where we still have a little bit, as mentioned earlier here, that there is a little bit of mixed bag, but I would say the positives are much overcome the lowlights, if you want, in terms of the what is remaining. Indirect taxes refunds within 2 months. I think there is an improvement required, and that's what has been addressed now on the direct taxes. A little bit of the old litigations, which create a lot of problems for most of the MNCs and other companies as well, holding in their balance sheets for long time. So that is in terms of the I don't see, and based on my experience, there is no pain as it appears. I mean, I was outside India in different restrictions, and I'm always hearing that the complications and the issues in the Indian taxes actually, at least in the last two years, and actually year on year, there is a huge improvement. I don't see it. I see it much better than any other country, at least in the Eastern Hemisphere, if you want, right? I mean, in terms of the timeline, in terms of refunds, in terms of the compliances. That also very important for the economy revenue, and that was very important during COVID. So I think in terms of compliance and in terms of the transparency. So as I mentioned, in the last 3 years, I never faced being, if I would say, expat, despite the fact that I have an Aadhaar card now. I don't see any transparency issue. I don't have any case. I've been in other countries where we end up having the multiple rounds of appeals for the annual returns. Things are going really in the very positive side. Now, one thing I would say that we recently faced this, starting this year, is the change of the tax rates, or mostly on the GST and the removal of the essentiality certificates exemption for oil and gas, right? I think this came into, I would say, a little bit fast action, where the country or the government wants to quickly refund or retain a little bit of the spend that has been done in the previous 2 years. However, it came, unfortunately, in my view, in the wrong timing, taking into account the inflation, taking into account the increase in the crude prices or the energy prices. So, removing the essentiality certificate exemption on the GST and customs duties for the oil and gas created a lot of increase in the energy bill in the for as an input for the other industries, created also the creation of the windfall tax as well is also a very fast move, where the economy didn't start the acceleration of the recovery and the growth yet, with the inflation, with the risk of the slowdown. So that's one of the issues that we are seeing it now. The unit the on the global level, I mean, as you clearly mentioned, now the movement of the OECD towards pillar one and pillar two. Obviously, this is more towards the uh, standardization across all countries to avoid any tax erosion and avoid all the negative impact of doing global business. All as long as it's a global thing, this will gonna bring more values to the business. It brings us to the previous discussion, where now it is to the bilateral agreements and the territory agreements between different countries, as we have seen between. Maybe there was one comment that we didn't see too much with Europe, but there is a lot of good benefit that doing global business with UAE, with other countries in Middle East. That is happening. That's seen a very positive for multinational companies when a lot of products movement between different places. I think also some of the work should be done on the SEZ or the other free zones in India that will facilitate the free trade with other countries. The element here, I think, also the importance of the global taxation. It comes in relation to the previous point where you are talking about the digitalization, right? The digitalization will come with a huge risk if you want. Number one, on the tax erosion, the escape from doing taxes. Number one, I wanted to add also on the digitalization, the risk of the cybersecurity and the risk also with the global impact linking it to the cybersecurity issues. One of the big risks at the national level for most of the countries. Right? So I think the tax element, the standardization or the global, will not gonna create a major issue. I think more a softener position on taxes in the tax rates and the exemption in India will help the business, especially in this current global and economical situation.
Yeah, so I think coming from an MNC, that's very good that you're finding that the tax environment in India has improved. That is very helpful. Mr. Vaswani, you have been dealing with a lot of businesses and as a in general, on just if you were to quickly summarize in terms of the tax and regulatory environment, what do you think? Where do we stand in? Have we made any progress, or have we created new challenges?
I think we have made a lot of progress as a country over the last few years, and the tax reforms that were brought about in 2019 yielded a lot of results. In the last couple of years, we've seen that it improved profitability, more competitive behavior, better tax compliance. Despite tax cuts, direct tax collections have increased year on year by 40%. for the last 2 years. I sometimes joke that if they were to list the direct tax department, it would be like a behemoth company with such large revenues and high growth rate that we're seeing. I still feel that despite all of that, the tax compliance still needs to be strengthened further. In our business, for example, we do face the issue that GST payments don't get done. So while you may pay the supplier or your service provider with GST, that person, that company or SME may not actually deposit it, and that then causes a lot of problems. It just disrupts the entire value chain. I think some mechanism should be introduced around compliance as far as some of those aspects are concerned, so that the liability doesn't fall back on the original recipient of the service, because that recipient has already made the payment, including the GST, for example. I agree that the cost of compliance has gone up in the last few years. Again, there is clearly room for simplification as far as that is concerned. I think indirect taxes, the the refund, the credits, they've been fairly tardy, at least as far as that coming back to corporates and industries is concerned. I think some of that definitely needs to be improved. So I think I'll leave it at that.
Yeah. So I think with that, now we come to the Q&A, session. So I see there are some questions. One question is in terms of the, it says that Indian economy, this is coming from Professor Dayashankar. Indian economy is stronger than most of the other countries. But why the value of the rupee has gone down against the dollar? So take example of Thailand, Indonesia, China. So I think the question is that if Indian economy, many people have said that India is right now the bright spot in the world economy, and where the growth rate in US Eurozone is now very marginal, and even China, which was always the it was always growing at a much a higher rate, is for the first time probably growing at a rate slower than India.
Yeah.
But then why is the rupee weakening? I think that's a very interesting question. Maybe let me ask Mr. Ian, as the banking and finance background person, to really share his perspective on this.
There are two aspects to it. In terms of the rupee, I think we saw very strong FI flows into India, which have been volatile in the recent past. There have been ingresses of FI funding and then it going out also, putting pressure on the rupee. In terms of commodities, also India has a very strong and vibrant domestic economy, which is usually dependent on import of hydrocarbons. Those prices also have been going up in the recent past. So even before the Russia-Ukraine issue happening, the OPEC was rising prices on crude oil, and that was impacting India. In fact, during the Russia-Ukraine situation, India was able to import oil at cheaper prices from Russia and also look at some transactions with Iran as well. So this whole situation is different from the other economies that were mentioned by the queryist. And this is probably what is driving this to my mind. And obviously the strengthening of the dollar vis-a-vis other currencies. So it's a plethora of things. And maybe India is a larger economy to that extent in terms of dependence on the global macros for commodities and dependence on investments.
And also probably while the rupee has definitely weakened against the US dollar, but it has strengthened against the euro and also some of the other currencies. So I think if you look at the basket of international currencies, probably we might not have done as badly as the US dollar would indicate.
Yes.
Yeah, maybe I would like to ask Mr. Darpan also his perspective on this question, because it's a very important question that going forward, do we see the rupee sliding further, or do we see rupee going back to maybe 75, 76 level, or will it go towards 85?
No, the reason I'm smiling is that, I wish we had a, crystal ball fortune, with us. I'll just share one thing that, about 3 months back, most of the people in finance industry were giving a target of rupee being at 83, 85 level somewhere by calendar Q1 of next year, and it has happened much faster than that. I think I would, step aside from this, trying to quote a number. These are volatile times. We always like to believe that what we are seeing is something without precedent, but these are unprecedented times. Very few times in history you see, a confluence of so many adverse as well as restructuring, events. We are hardly passed out of COVID, and getting into geopolitical issues, and many more things happening, So very, very volatile times, very hard to predict as to where it will go. I don't think it will go down anytime soon. The fundamentals don't support that. I don't think we'll, get better than 81, 80 anytime soon. Fundamentals don't. Now, what will the pace of deceleration, pace of, change into that? That is something, we can't call out. But please, I think we should expect some more devaluation.
So there is another question for Mr. Ian that do you see the non-performing assets going up in the banking sector?
So I think we've already seen the whole corporate cycle play itself out. So if you look at it in couple of different brush strokes, so I don't think you can club everything into one. One is you have the retail, second is you have MSME, third is you have large corporates. So we've had in the banking sector a fairly difficult credit cycle when it comes to large corporates. Over the last 5 to 6 years, you would have had a lot of the infrastructure companies, a lot of commodity-based companies, a lot of companies that speculated on land prices actually buckle and go under. You had a few large NBFCs also buckle and go under because of exposure to the underlying economy, especially the MSME sector. And that's where it's at. But if you see the current book, I think it's relatively robust. The standard asset book of the banks today is based on originations done in the last 3 or 4 years, wherein the asset quality and the whole, one second, sorry, the whole way in which origination is done has changed. And even if you look at it from a business model perspective, the companies have been looking at it in terms of whether they have financing tied up, whether they have the end use of whatever they're producing, be it power or be it downstream processing of commodities, whether that's tied up or not. Whereas if you see about 6 or 7 years back, the companies that contributed to this debacle in corporate credit defaults were far more exuberant. The whole business model was not thought through. So you had defaults in also aviation and other sectors. But I think in the last few years, the lending has become more robust. Whatever had to happen has happened. Both it had started to happen pre-pandemic, and through pandemic, it has been the death knell of the weaker companies. So it's unlikely that we will see NPA build up. So you will have NPAs, that's a part of life, but it will not be to the extent we saw in the last few years. So you should see reduced and better performance on the corporate book. In terms of retail, I still think the economy is relatively strong. The consumer is still boyish. Yes, we are seeing headwinds in terms of inflation. But as I mentioned in my earlier remarks, the interest rates that you're seeing in the retail space is nowhere like we've seen peaking in the last 4 or 5 years prior. So we still have a benign, though higher than in the last 2 years. It's higher today, but it's still not reached those critical levels. So retail is likely to perform unless you have, we've seen in the recent past some of the startups let go employees. If that contagion spreads of unemployment increasing and rearing its head, perhaps you could see NPAs in the retail sector. As of now, we don't see that happening. The third is the MSMEs. That continues to be a cause of worry for bankers because that's a sector that has not fully recovered. And while it was beginning to recover post-pandemic, the whole global situation in terms of volatility has not helped many of these MSMEs find their feet. So while there are the knowledge-based MSMEs which are likely to do well, sectors, defensive sectors like defense, pharma, and probably MSMEs related to infrastructure, these would do well. The traditional MSMEs could continue to be a source of worry and NPAs going forward till there's a resolution to that set of problems.
Yeah. So one very quick one question which is there, that one or two things what CFO must right now sort of do in this environment. Any quick tips? Let me ask Mr. Darpan. That's what there is a question, that what CFO in this environment, one or two things he must do.
I think one thing is that the planning cycles, while keeping an eye on the long term, I hate to say it, the planning cycles or the execution cycles, or the first matrices of success, they should be slightly closer to today's time, rather than doing an annual operating plan like earlier. Maybe I would want to do a 3 months plan, 6 months plan, and then continually check my performance against that. That leads to the second thing, that I think the diligence as well as the scrutiny of different animals of elements of financials, whether it is revenue, whether it is supply chain, and not only looking at the numbers, looking at the longer term trends and where it is heading. I think applying some diligence to that, benchmarking, I think these assume criticality. So analysis and diligence around numbers becomes all the more this thing. One big role of CFOs, or I would argue even all business leaders, is the overall risk mitigation. So keeping your eyes and ears open, looking for inputs which could change or dramatically shift consumption patterns or the supply, either the supply side or the demand side of your industry. Just keeping a closer watch on those. I would encourage finance partners to speak more to and not only finance CFOs but the other people also, just to get a better pulse of what is happening, so that can be built into plan as well as into analysis. These are
I think that is extremely relevant. I think that is very, I think risk management and your having planning cycle, not the annual budget, but maybe shorter cycle, revisit all the elements. Maybe I just hand over back to now Mr. Ankit and Mr. Vaswani for their concluding remarks. There are some other questions, but I think in the interest of time, I'll hand it over back.
Yeah, thank you so much, sir. Now I would like to invite Dr. Vasi to give his concluding remarks.
Yeah, thank you very much, Ankit. Thank you very much, Dr. Suresh, and thank you very much, Kailash, and all the panelists here for this great opportunity. Again, I was hoping to have this in person, and I would thanks everyone who attended this. I think, in summary, we are going into a very dynamic period where a lot of nowadays is systematic factors and unsystematic factors, I mean, are impacting the businesses. The collaboration, I mean, as most of the team here are CFO, and one of the tips here is to more in relation and engagement and insight information or market intelligence from different parties. I think from supply chain organization, from dealing with the sales and marketing in every single organization, the role of the investment banks, the role of the MNC is very big right now to support the growth of the business and support actually the authorities and the MSMEs to further grow and avoid any potential risk. I think the SMEs, the multinational, the MNCs are and the big companies are required now to support the SMEs and the small companies to take them to the next level and avoid any failures. The more interaction sessions with this with ASSOCHAM and other parties will be really important to keep addressing all the potential risk, knowledge sharing about what are the best practices to avoid those kind of or hedge against this risk. Again, thanks for everyone, and thank you, Suresh and Ankit, for leading this, and thanks a lot for everyone joining this and making it a great platform for knowledge sharing.
I would like to thank all the panelists for their insights and the, I would say, wisdom and on the ground experience what they are seeing. And also, I would like to thank ASSOCHAM for their participation.
Thank you very much, all. It was a
Thank you
pleasure.
all.
Thank you so much, sir.
Yeah,
Thank you.
Bye.
Thank you. Thank you, everyone.
Thank you.
Thank you very much.